Happy weekend again, everybody. It is Wes, and we're back with Pikes Peak Trades for market summary video that's closing trading for the month of July 2022. And I've got a lot of really significant things to talk about. So I want to take you through what I think is a building set of evidence for a primary degree bottom in place. I want to take you through some things on monthly charts and weekly charts that are going to add some evidence to that, give you updated counts, and then talk about where I think we're going to be going in the first week of August. So if you've been following me for a number of weeks, you know that I've been talking consistently about the importance of the S&P 500 quarterly chart that we got in the second quarter of 2022. We got a significant close below the 8-quarter EMA, and history has said, going all the way back through the inception of the index, that if you get a second close below that 8-quarter EMA, that's when the worst of the bear markets happen. Those have coincided with significant recessions, long-lasting recessions in the 70s and through the dot-com burst and also through the great financial crisis. And where we stand right now, 1 month into quarter three, we are solidly back above that 8-quarter EMA, 100 points above it right now on the S&P. Now, it's critical that the next 2 months at least maintain that. I'm going to suggest when you take a look at monthly charts that we might not necessarily see a huge finishing explosion to the quarter. We might actually see an inside month or two, but as long as we can continue to establish price that would set it up for a close at the end of September above that 8-quarter EMA, the market history suggests that that's when we could see bull market continuation in all these bubbles that you see going back here almost 30 years. Okay, into the monthly chart now, and you're going to notice on the S&P, very, very close to a monthly bullish engulfing candle. You're going to see that those were confirmed on QQQ and IWM. To me, it's not a non-confirming technical measure that the S&P did not close with the monthly engulfing, because it's actually in the history of the S&P very, very rare for that to happen. Now, one instance where it did happen that led to a second leg down was actually in the bear market of 2015, early 2016, and I have that as a primary 4-degree correction. I have this as a primary 2, so of a similar degree. So we still can't rule it out yet that what we have here is just an X-wave bounce, and that we're eventually going to sell to new lows. That's not yet able to rule out. I'll give you some levels where I think the probability is going to start to diminish. But I think as we build this weight of evidence, is we're going to see there's much more evidence in favor of a bottom, looking at the technicals. I'm not worried about the macro and the news, although the market this week was able to shoulder some pretty bad news, multiple sets of news that was not good, but the market continued to move up. And when that happens, that is a bullish sign. That is what happens at bear market bottoms. The market can shoulder bad news. And so right now, just if I give you my brief opinion on that, is that the stock market is forward looking to a short recession. It is clear that we are in recession. You know, you can let the White House use their talking narrative all they want, but using the historical rule of thumb, we did print a recessionary GDP for this second quarter. And what I think the stock market is saying is that it's going to be short-lived. Okay, now back to that quarterly chart. If we do get that second quarterly close, the stock market is saying that is not going to be a short-lived recession. Okay, so right now, the indications from the technicals are that I think the stock market is able to shoulder that bad news, saying that this could be a very short recession. Maybe we're already out of it by quarter three, and then we're going to be zooming up into, I think, a decade of really good pricing for the stock market. Okay, on the monthly, you're going to notice a recapturing of the 21-month EMA. You're going to see recapturing also through weekly closes. And if we can get August above the next set of EMAs, so it's going to be at 4,200. We can get a close in August, even September. August might not be overly bullish, but by September, if we can close back above all those monthly EMAs, I think we have significantly reduced the probability that we are actually only in a bear market rally and that we've actually got that bottom in place. Taking you through the weekly, okay, and the weekly is here where I want to actually move into the weekly on SPY. So you can see that the weekly has recovered all the EMAs except the 50 SMA. If I take you through the weekly on SPY, what I'm wanting to show here is that we have a weekly MACD bull cross. Okay, and I want to talk about, along with what I'm going to talk about in a little bit, monthly bullish engulfing candles on other ETFs, is what is the probability or the let's say the level of occurrence of a weekly MACD bull cross within an ongoing bear market. Okay, so let's just start dropping back in time. I'll start compressing the time frame here. That in the COVID crash, that was what I have as a quick C leg down of a cycle degree correction. It's not labeled on SPY, but if I go to SPX, you're going to see that I have that as a primary C of a cycle 2. We were never in position to even attempt a weekly MACD bull cross. That didn't happen until we got into May and June of 2020 that we saw that cross. So that's not a great example. What we're going to have to do is we're going to have to go back and compress this into the great financial crisis. So we dig back into the great financial crisis, and we want to know is, did we have a MACD bull cross that led to a second leg down of selling, a final leg? And we actually did. Okay, so it actually did occur in late 2008. In fact, this was the very, very last week of trading in 2008. And then we got into the first quarter of 2009, that nasty final leg. But I want to point out to you a very, very stark difference. You'll notice that at this particular leg, so the low of November 08, there was no weekly divergence on that MACD. Okay, so without that weekly divergence, you could have said, well, we need that lower low to set that weekly divergence because that's one of the stronger bottoming signals on the higher time frames. So now let's advance it. Okay, so did we get weekly divergence at the yearly low? And yes, we did. Let me zoom that back so you can see that a little more clearly. And you'll see that we did. So we had the spike low in the middle of May, and then we set the divergent low in June at the yearly low. So what I'm offering to you on that RSI is that we have the potential here that this will actually stick. Okay, so we do have some bottoming indication that this could be more on the weekly than just a bear market rally. Again, remember that I use a weight of evidence. It's a probability approach. Anyone that talks to you in certainty is either insecure, they're trying to use bold, broad language to mask uncertainty, or they're just incompetent. We can't say with certainty that this is a primary low, although I think the weight of evidence is suggesting that in fact it is. Okay, so that takes us through the higher time frames on the SPX. Now we get into the daily, and we can see where we're at in this counting. And I had been offering to you really the last 2 weeks from my videos is I said, don't discount the possibility that the market is going to shoot up in this minor 3. And that's exactly what it did. The last 2 weeks, we got just rocket moves that dips were able to be bought. And so I just suggested to you, if your bias was bearish, have an open mind. If you were playing these counts, you had a phenomenal last 2 weeks, and we certainly did in my group. We were on the right side of these trades, multiple members with phenomenal plays in multiple sectors. And so are we set for continuation? And that is what my main count in white would suggest, is that we are still in the middle of a minute 3 of minor 3 as the first 5-leg thrust off of a significant low. Okay, now, if this is bearish, if this is just a bear market rally, I think the highest probability move would reject before the June 2nd high is broken. So that means that we would see an immediate rejection into the final leg down. That would correspond kind of what I showed you in early 2009. I think if we break that June high, and we do it across the board on IWM and QQQ, I think the probability reduces significantly. There still could be one more chance of rejection at the 200-day SMA, but we already have some individual stocks above that. So you put all that together, and my counting is still looking for continuation. Now, with that said, that doesn't mean that we just go straight up to 43 or 4,400. It is totally possible that we have set an internal 3 top and we're ready to cool off Monday in a wave 4. Okay, now I want to offer to you some other technicals here that I'm using to try to talk about overbought levels that could result in pullbacks. And one of my favorites is NYMO. So this is the cumulative advanced decline issues. Sorry, it's not cumulative of advanced decline. It's a weighted indicator of that. It's actually a moving average indicator of advances to decliners. And you typically use a close above the upper Bollinger Band to communicate an overbought condition that could give you a snapback pullback. That's exactly what happened in late May, early June. And the interesting thing is that did not happen on Friday. So while that's a pretty overbought reading, near plus 90, we're not actually above the upper BB. And so what I think could happen is I think we could still have maybe one more day of continuation to reach that oversold level. So that would push the S&P up into this more typical fib. It's already reached the 1.0. When I show you on QQQ, you're going to see that I think we could extend a little bit more on Monday. Then we get that pullback early to midweek before we continue to advance up in this wave count. So if we do see weakness right away Monday, we're going to be ready for it. We've got levels. I'm looking for something right around 4,100, maybe as low as 4,080. But we would want to see this fib level hold. We certainly don't want to see price within this minute 3 break back to this wave 1. And that high is about 40.39. So if that price is broken into, then we've got to consider the possibility that we might have actually gotten that bearish rejection underneath the June highs. Okay, so that takes you through the SPX on all time frames. SPY, very, very similar, but if those numbers are just more relatable to you, if you trade them more often, then I would be looking for any pullback right around 407, 408 as your next opportunity to buy that dip. And while we're looking here at that short-term chart, you can see the dips that were so good to buy. So we nailed this one Thursday, and then you had another one right off the open Friday that if you just bought with confidence against these previous higher lows, then you made money. If you tried to short this week, man, look, you're shorting into a 200-point move on the S&P, a 20-point move on SPY, and you just got taken out in a body bag. So you got to pay attention to price action and pattern, and we're going to be ready. We'll be ready for continuation early in the week, but we've got our eyes on the next viable pullback before we can move up to challenge those higher fib levels. Okay, so now we're going to get into some really interesting things, take you into the QQQ monthly. And look, we have a confirmed July monthly bullish engulfing candle. It is actually much, much more common on the Qs than SPX to get that bullish engulfing candle. I think the explanation for that is pretty simple, that the tech index, without having the weight of industrials and financials and healthcare, is just much more able to respond to a risk-on environment by printing these kinds of candles, as opposed to the S&P that hasn't more often. So the question that we have to answer is it likely or common to see a bullish engulfing monthly candle in an ongoing bear market? Okay, so we go back to the .com bust. So the inception of QQQ was just right before that bust. And there are no monthly engulfing candles within this ongoing bear. Where do they occur? They occur in ongoing bull legs all the way through the first cycle. Okay, that set the higher low here in November of 2008. Okay, and look at the confirmation off of higher low pullbacks right there at the bottom in the S&P. Remember, the Qs bottomed at a different location than the S&P in 2009. There's your monthly engulfing. There's another one here that we're going to talk about that corresponds really well to IWM in October of 2011, and they just continue to occur at advancing levels. The most recent one, April of 2020, had the huge push into the all-time high. So the weight of evidence suggests it's much more common for us to get, in fact, almost all instances are indications that we get bull market continuation. So I think it would be a very dangerous call into this candle to say with any type of high probability, and if you're using the word, I'm for certain that we're going to see lower yearly lows, I think you're just kind of spitting in the face of historical technicals. And so I would say that this approach is offering to you, along with what we've seen on the S&P weekly MACD cross, that it is much more likely that we do in fact have a bottom. Now, unlike the S&P, a lot further to go on the Qs because they retraced almost to that 0.618 while the S&P was above the 0.5 fib, that we've got to see that back above 330. And does that need to happen in August? No, it doesn't need to happen in August. But again, we've got quarterly closes in mind. So by the end of September, if we've recovered those monthly EMAs, even more evidence at that point is stacking up that we could see an amazing run in tech and growth in this decade. Looking into the weekly, and you're going to see on the weekly, let me slide this back over so the view is better for you, that we have just that final 50-week SMA to conquer. We've conquered all the way through it. I would also point out to you, because I think bears would say, well, this rally is just like what we saw through March up to here, that it's really the same. There's one more leg down coming. Notice that weekly candle that closed March. That's very different than the weekly candle here. This is much more of a hammer look, approaching more of a bulls in control. This had a shooting star look. In fact, it was absolutely confirmed as a shooting star with the bearish engulfing the next week. That is not the same candle look that we have at this, what I have as a B wave top. So for bears that are saying that this is an X or a B wave top, I'm looking at that as, well, it just doesn't have the same look. I would also point out to you that using that June 2nd high on the S&P, Qs are already above it. So we are seeing tech lead out. And we saw, although the earnings results were misses from a number of the leading stocks in QQQs, the responses were still positive. And those misses were not that bad. The misses for Microsoft, Google, and Meta were in the 0.2 to 0.4% range of a miss. That is not a bad miss. And then we saw Apple beat with the surprising move, and we'll take a look at the strength of the Apple chart, certainly leading up and out. So I think this is a really good look for continuation. We're looking for the cues in the minor 3 to get into the 320s, and if I take you into the daily on the cues, we're going to see an upper BB close. So I mentioned NYMO did not do that, but cues did. And it's not uncommon to get multiple days of that. So that happened in the mid-July run. And we could see another couple days of an upper BB challenge. And certainly at this point, I've got to change this count because we would not expect this B wave to go higher than a higher degree X wave within a bear count. So this would have to be modified. And at any time, here at the close of a week and a month, if I'm taking a potential bear count and I'm having to delete it because of invalidation, that again is taking some evidence away from the bear approach. So I would still say the weight of evidence continues to stack up, that we're strongly moving up within something that could be very surprising and on the cues. So because we did not even yet reach the 1.0 level of this minuet wave 3, I think we could see some continuation upwards. If I put that 1.0 level there for you on the screen, that we could see it above 318, maybe a spike up, and then possibly we get that wave 4. It's also possible that we just move right up to the 320 area before we get that wave 4. And so we just have to be ready for it. But we've got counts and we're at the ready for whatever we get. I would offer to you in blue that because of the different way that Q is counting, and possibly the much more bullish way, is that we could have a 1-2-1-2 if the S&P immediately goes into that wave 4. So if we see weakness that pulls the S&P back under 4,100, that we could see Qs move back to about 311, but it would just be another nested 1-2, which would then extend all of these to the higher fibs as long as this pattern continues to get bought. Next one I want to show is IWM, because IWM also with a monthly bullish engulfing candle, and we go back through the history of IWM. That did happen within the first 3 months of the beginning of the ETF. That opened right at the start of the dot-com bust. I'm not going to give that much evidence to that candle all the way back in August of 2000 because that ETF had just opened. It didn't happen again until that push in October of 2011. You saw that on the Qs as well, and that set off a primary 3 move. And I just want you to see how this could be rhyming here. A primary 1 low off of the great financial crisis low, cycle 2, primary 1 to primary 2, 0.5 to 0.618 fib, off of a cycle low in COVID, primary 1, primary 2, into a 0.5 to 0.618 fib. I love that symmetry. I love that candle. We've got the possibility that we could see an incredible move in small caps. So again, just keep an open mind. And as this evidence continues to stack up, if your bias is decisively bearish, you at least need to be aware of the possibility and the probability that you may be wrong. It's going to take an immediate reversal of the bullish engulfing candle in August. It would have to be nasty. We would essentially need August to undo all of July's gains in order for this to have another leg down like you would see here. But as we continue to approach those June highs, just like in the S&P, that probability is going to gradually decrease. So my trading plan and my trading money is on the bullish continuation in the month of July. That's what paid the bills. And we could continue to see continued movement up in what I have as a minute 3 of minor 3, exactly the same wave progression as SPX and QQQ. Into the small time frame, again, it's possible that we've reached a degree 3 top. We do have to leave those bear labels on because we haven't yet exceeded the price high in June. That count will be taken off. If we do, I think at that point, we've established enough evidence for me to only move forward with the primary bull count. And we're just going to have to see, do we take a shot at 190 into this upper fib before a degree 4? Does it happen right away? We just have to wait and see. If it does, you can see the fibs that I'm looking at. I wouldn't expect it to go any lower than about 180. Okay, so we've got just some amazing set of bullish evidence historically suggesting that we need to be ready for primary bull continuation. As I mentioned, if the bears are actually still in control, it's going to happen throughout the month of August, and it's going to have to be immediate, and that's going to have to then continue through the end of the quarter. And we won't be surprised. Like we'll know pretty much this first week of August if that's going to start having a chance to build back probability. But if these fibs continue to play out, we continue to stack that evidence up in favor of the bulls. Okay, let's look now at growth. So we get into ARKK, and we're looking here at the monthly candle, up about 13%. Not a bullish engulfing candle, because ARKK actually opened the month of July higher than it closed in June, and that certainly sets it apart from the other ETFs. Now, we didn't get much finishing continuation in July from ARKK, mainly because we had just a bunch of growth stocks that reported some weak earnings. So Shop, that rebounded, but then had kind of a weak close Friday. Roku especially is heavily weighted. TDOC also heavily weighted. Other than Tesla, really there wasn't a whole lot for the individual stocks in the ETF to get moving. But what I would still say to you is, from a technical perspective, we're still above that 8-week EMA, and I think still just building out some base work here for a move up. There are still a lot of big names within it yet to report. Zoom, the middle of August. Square coming up this week. Twilio yet to report. So there's still the possibility that other earnings could come in surprisingly better. We get into the daily. And so on the daily here, you're going to notice just a lot of kind of choppy sideways action. Could bear certainly say that it's a bear flag? Absolutely. And if we were to break down and lose a progression of higher lows, so you just stack these up, and if they start to fall like dominoes, then we get more worried. 43.41, to me the bigger one is July 15th at 42.20. If we lose that low, the most bullish nested progression is gone. And then at that point, I'm forced into a much lower probability bull count, which would be a leading diagonal. 1, 2, 3, 4, 5. And I wanted to adjust this fib for you to at least show it in ARKK, because that's also still a possible count for the S&P and the Qs if we see August that's much weaker. And so I would take this fib away, and what